So here's the truth bomb to kick some things off. The IRS doesn't care about your intentions. Hello, it's Steven. Welcome back to Savvy or Surrender. Today, we're diving into a topic that has the power to completely flip your mindset and your bank account. What the wealthy know about taxes that you probably don't. I'm not here to throw shade. Most business owners were never taught this stuff. But once you know what I'm talking about and I'm going to share, how much money you might be leaving on the table every single year. So here's the truth bomb to kick some things off. The IRS doesn't care about your intentions. They care about your documentation. And they definitely care about your math. The tax code, it's not unfair. I'm so tired of hearing people say, oh, the tax code's unfair. Is it complicated? Yeah, it's complicated. It's just misunderstood. It's actually a reward system. It rewards people who create jobs, invest in real estate, fund retirements, and support clean energy. The wealthy, they're not cheating. Business owners aren't cheating. They just understand the rules and play by them better than most. I was talking to a potential client the other day and I said, we didn't make the rules, but we know how to follow them and how to use them in our favor. So that's what we're looking to change today. Give you the rules to understand how to play by them so that you can also take advantage of the different ways to use the system to your best advantage. So, tax prep versus tax strategy. Let's talk about that first, because a lot of times when I am talking to people coming into our office, they will say to me, well, my CPA, my tax pro, they already use tax strategy, right? Like they give me strategy. Or maybe they say, no, they're not, right? They're not giving me any tax strategy. I feel like they're working for the IRS. I feel like they're a secret agent for the IRS and they're not on my side, but they're on their side. Well, tax preparation is backward looking. It is what most people do, quite honestly. When you're going on TurboTax or you're using a CPA or H&R Block or whoever it is, they're just simply putting numbers in boxes at that point. They're reporting what has already happened. And sure, maybe they'll find some write-offs, maybe they'll ask you some questions, but they're not really able to change much from the future, right? Because tax strategy is forward-looking. It's about designing your outcomes. What do you want your outcome to be? So when I'm meeting with my tax strategy clients, and we meet throughout the year, and we're asking them, what is it you want to try to accomplish? What is it you're looking for? We use Stephen Covey's book, The 7 Habits of Highly Effective People. One of the habits is begin with the end in mind. And that's usually one of my first questions that I ask is I'll say, what is it you're looking to accomplish in the next couple of years? And then we can look at what strategies make sense for them based on that. So you need to be meeting with your tax professional or somebody who's going to give you tax strategies on a regular basis, not just when it's time to file. Think of it like this. Tax prep is like brushing your teeth once a year. Tax strategy is brushing and flossing daily, so you're not shelling out for a root canal. What we'll actually do is kind of look at what the wealthy are doing, and we're going to pull back that curtain on the playbook that they're using and be able to maybe see some of the strategies that they're using. So here's a quick rundown. Entity structuring is probably one of the biggest ones. They don't just default to a sole proprietor. A couple episodes ago, I talked about all the different entity structures that are out there. Well, it is imperative for tax strategy purposes to make sure that you are set up correctly. In fact, we just brought in a new client that he's been operating for years now. I think he's been in business, gosh, I don't even know, at least 8 or 9 years. And he is still an LLC. He's probably doing close to $400,000 to $500,000 in gross sales. I'd say he's probably getting a net income of well over $200,000, and he's just an LLC. He is missing so many tax write-offs available to him by not being an S-Corp. So the wealthy, the business owners, the smart, strategic business owners, they're using S-Corps, C-Corps even. A lot of times people, they don't like C-Corps because of the double taxation that's attached to a C-Corp. But quite honestly, with a 21% corporate tax rate, it's not that bad anymore. And a C-Corp might make sense to be able to help you on your tax strategies. And then there's things like using a trust to protect assets. What about hiring your kids? Let's talk about that one real quick. That's another strategy that the wealthy will use to be able to write off things like, for example, Taekwondo. I use the hiring your kids method for my 8-year-old son. He comes in here and he vacuums. I think I talked about this on a prior episode, but he vacuums, he mops, he shreds paper. I pay for him to do that, right? A going wage. I have another employee who makes $15 an hour, another employee who makes $20 an hour. So if they were to do that, that's how much I would be paying them. So that's how much I pay my son to do those things. And then when I pay him to do that, he then pays for his Taekwondo lessons, $175 a month now. So that's how I am writing off legally his Taekwondo lessons. They pay, or the wealthy will pay their children to work in the business. It shifts income, reduces taxes, and a hidden benefit here is that it teaches, not only does it teach financial literacy, but it teaches a work ethic. So I did this growing up. I worked in my dad's landscape business. And I thought, I just got to go to work with dad. What it really was free childcare for my parents, because that way they didn't have to pay for a babysitter or whatever, right? So when I was there working with my dad, I remember one summer, I was probably, I want to say 9 or 10. I could be wrong on the year, but I negotiated, if you want to call it that, negotiated a rate of 50 cents per day to work for him. And I was going to sweep and do a couple other things, whatever I could do, clean up the weeds and that kind of stuff and put them in the truck. And so I did that. And one of his workers said to me, "You're only making 50 cents a day. You need to renegotiate a better raise." And so I went to my dad and I said, "Hey, I need more money. Like 50 cents a day is not enough." And he told me no. He said, "That's what you negotiated. You wanted 50 cents a day. That's how much I'm going to pay you." And, at the time I wasn't very happy with it, of course, but in reality, like, that taught me something, right? You negotiate something, you put something in a contract and you stick to it. So there have been times that I have negotiated rates for clients that turn out to be too low. I didn't charge enough for the work that was there, but that was what I negotiated. That was what was in the contract. And so that's what I'm sticking to until the time is up to renegotiate, and then we can take advantage of that. But I've learned those principles because I was working with my dad. The Augusta rule is another great tax strategy. You hear a lot about this on social media. Quite honestly, I feel like it's overplayed, but you get 14 days a year. If you haven't heard about it on social media, you get 14 days a year where you get to write off the income completely free. Now, you don't get to charge the expenses, but you also get the income to be able to write off. It's a legitimate deduction if you do it right. So think of it this way. Let's say you are a contractor and you want to do your safety tailgate meetings at your house. Not literally on the tailgate of a pickup, right? That's what they're typically called, but let's actually go inside the house, outside from where you normally hold business. So if you have a home office, you can't do it there because then that's what the home office deduction is for. But you do it in the living room, maybe you do it in the garage, wherever you're going to do it. And you do this safety meeting, you rent out this location, your house, you rent it out for the day. Now, the key is to, one, make sure that you're putting this in your operating agreement, board meeting minutes, whatever it might be, whatever the event is for. But once a month, you do this safety meeting at your house and you rent it out then for the going rate. Now, what is the going rate? It's a great question. Let's figure it out. Let's go online and see what it would cost to rent an office or room, something for the day. If you were to try to rent a conference room from, let's say, Regis, who typically rents office buildings or conference rooms or something like that, or you rent a hotel room, a meeting room for a day, what are they going to charge you? $500, $400? I don't know. It depends on your area. In Seattle, I have a client there that we figured out it was about $800, $900 that he would get for the use of his space. In Iowa, I have a client who it was only going to be a couple $100, only going to be like $300. So, we've got to do it based on that, right? Because the IRS, if they look at this, we've got to show them that we did our due diligence, we did our work, and this is why we did what we did. So what you then do is you are able to write that off on your business and collect it as income personally and not have to recognize the income. You get the expense on the business side. You don't recognize the income on the personal side. So if it's, let's say $500 times 12, and so you get to write that off, and that's 12 days, right? You get 14 days. Maybe you have a client appreciation party at your house as well, whatever it might be. So those are the ways that you use the Augusta rule to be able to help you in business in another strategy. And then we have cost segregation. Now, the prior ones that I talked about, I consider to be kind of the core strategies. Those are gimmies, right? Those are strategies. These aren't loopholes. These are written in the tax code, audit tested things that you can do as long as you do it correctly. Cost segregation is more of the advanced strategy. You need to be an investor in real estate to be able to use it, but it is a fantastic strategy for real estate investors to use to be able to write off a large amount of money very quickly when they purchase a property. So for example, I have a client who just purchased a property in a ski resort area. It was already an Airbnb. So they bought the property as an Airbnb, fully furnished. That was part of the purchase price. Now we're able to use a cost segregation study. And there's a couple of ways you can do those studies, but they're able to use a cost segregation study to then write off a larger percentage of the home that very first year. So here's how it would work normally. So depreciation on a property, if it's a regular house, is normally 27 and a half years. If it's a commercial house or commercial building, hotel, something like that, it's 39 years. Now, Airbnbs have been decided that that's commercial. It's commercial use, so you get 39 years over that time. And you can't depreciate land. So let's just say they buy that house in the ski resort area for $1 million. And the land is 40% of that, or $400,000, just as an example. So now we have $600,000 to work with. We do the cost segregation study, and they determine that with all the furnishings, the plumbing, the HVAC, the flooring, all that kind of stuff, they determine that it's about 40, 50%. Let's say 50%. So of that $600,000 that we would normally be depreciating, we're going to take $300,000 of that, and we're going to depreciate it faster. Now, with our bonus depreciation, thanks to the One Big Beautiful Bill in episode 2, we talked about that, bonus depreciation is back to 100%. So we can take all of that cost segregation, all of that $300,000, and depreciate it right now. And if it's a short-term rental, an Airbnb, we get the short-term loophole, it's called. I hate that word because it's not a loophole. It's written into the code. You get to be treated as a real estate professional. You got to qualify certain things, but you become a real estate professional and you get to write that $300,000 off, or up to that amount anyways, against your regular income. So how do you get rid of, $45,000 in taxes or more? You write that off, that $300,000 off right away. And there goes $45,000 in taxes, because that's $300,000 of income. Let's say we have an effective tax rate of 15%. And I could go into all of that stuff, but let's just say we have an effective tax rate of 15%. roughly $45,000 that we just wrote off by using the cost segregation study. Not to mention, then down the road, we still have another $300,000 that we're going to write off over the next 39 years. So we still have all of that we get to do as well. Okay. Section 179, another way to use an advanced tax strategy. It's another one of my advanced ones that the rich use. I have a client, two clients actually, that we're doing this right now. One is a doctor here in Idaho. Another one is an engineer in Seattle, that they make significant amount of money, but it's W-2 income. They don't have a way to be able to write to do things like business expenses and stuff like that, because it's just W-2 income that they're making. So we set up they become a business owner. We set up a new entity and they buy equipment. And then we're able to write that equipment off in the first year using Section 179 up to a certain amount. And so again, we're able to eliminate, one of them bought $400,000 worth of equipment. The other one is in the middle right now of the transaction of buying about $500,000 in equipment that he will be able to use against his income. He makes a significant amount of money, more than that. We're able to write all of that off against his income because he's going to be an active participant in this LLC by looking at the equipment about 100 hours. He's got to look at the equipment. He's got to, choose it and be active in the business. But by doing that, he's able to write off active income and have all of that $500,000 or a portion thereof, whatever makes sense, written off. So again, let's say he's at 20%, right? Because it's a higher income. So he's going to have some in those higher thresholds, those higher tax brackets. So let's say his effective tax rate is 20%. You write off $500,000. There's $100,000 that he just wrote off. How does a person making $500,000 a year not pay any in taxes? That's how. Completely legal, completely just using the tax system for us. So now let's go back to one of the core strategies that I really like, and because it's a core strategy. It's one of the simpler strategies, the more obvious strategies to use. You don't have to be making $300,000, $400,000, $500,000 a year. You could be making, my qualification is generally about $50,000 net income in your business. This makes sense. And that's the S-Corp payroll optimization, basically. So with an S-Corp, you pay yourself a reasonable salary, and then you take the rest in distributions, saving on the self-employment tax. So first of all, let's real quick talk about what the self-employment tax is. That is your Social Security and Medicare. If you are a W-2 employee, you pay 7.65% a year up to a certain amount of salary, and then part of it gets cut off. But you pay 7.65% on your wages. If you are self-employed, and then your employer pays the other 7.65%. If you are self-employed, you pay the full amount, 15.3%. Now, when you pay that 15.3% on your wages, everything flows through. If you're an LLC and you make $100,000 in your business, you're paying $15,300. And there's a little bit of differences here and there with the QBI deduction, things like that. But let's just call it $15,000 to make it easy. If you become an S-Corp, you can say, I want W-2 wages of, let's just say 50%. Generally, it's about the 30 to 50% range, but let's just call it 50% here at this level. So you pay yourself a W-2, $50,000 or $48,000, $4,000 a month. You've reported in there, you get the payroll, and you pay your Social Security, Medicare 15.3% plus your federal withholding, your state withholding, if your state holds taxes as well. You pay all of that on your wages that you report on your income every quarter. You have your federal 941s and your state forms, things like that. You pay your taxes. The distributions, you still have to pay your federal and your state withholding, but you don't have to pay your Social Security and Medicare. So you're saving 15%. Right there in that example, on that $50,000 of distributions, you're saving $7,500 basically. So that's where the savings comes in for that. Now, what is a reasonable salary? The IRS does not define what a reasonable salary is. So how do we know what it is? Well, what they generally say is that it's whatever you're doing, right? So if you are I had a client call or a prospect call, and said that they were an architect and they felt like they couldn't change their $100,000 salary. And if they became an S-Corp, they felt like they still needed to be a $100,000 salary, and they weren't going to really save any money, according to them, on this S-Corp payroll optimization. So when I asked him, though, how much of his time was spent being an architect, he said about 20 hours. I said, okay, fine. 20 hours a week, you're an architect. What are you doing the other 20 hours? Well, he's the CEO of the business. CEO means chief everything officer, right? So sometimes he's answering the phones. Sometimes he's doing marketing stuff. He's advertising. Sometimes he's sweeping the floor, taking out the trash, cleaning the toilet, all those things, right? I just did it. I just cleaned my bathroom. It happens, right? That's what we do sometimes. When he's doing those things, he doesn't make the same as what an architect makes. If he's answering the phone, if he's responding to emails, he's making what a receptionist or what a office assistant is going to make, $15, $20 an hour. So if we really break out his reasonable salary and we look at it specifically to what he does, and we can break it out and we can show the IRS the reason why this architect can make a W-2 of $50,000 is because of this, and we could show them exactly why we came up with this salary and we had a reason behind it, they're going to take that much more likely than if we just said, the internet told us 50%. And so that's what we went with. It doesn't make any sense. It doesn't work that way, right? The IRS is going to come back on that one. So that's where we come up with the reasonable salary. We can kind of figure that out, back into it, and be able to save you the money there. All right. The next one is the accountable plan. So if you become an S-Corp, you lose the opportunity to do certain things. All right, so let's talk about accountable plans. They reimburse yourself, or you, as the owner, you get to reimburse yourself under the accountable plan for things like the tax-free use of your home office, mileage, cell phone, whatever it is that you as a business owner, when you're going out and you're having meals with clients or prospects, marketing, advertising, one-on-ones, when you go to a networking event, something like that, that's all going to get reimbursed under an accountable plan. So those regular expenses, maybe cell phone expense, something of that nature, where you as a business owner, you experience those expenses because of running the business. And it's interesting because if you look at what you do on a regular basis as the business owner, you will probably find a lot of expenses, even things on your personal credit card maybe, that you should have been reimbursed for, but you didn't charge it to the business because you didn't think about it, or maybe it was too difficult to change the expenses, whatever it might be. Perfect example of this is just last night. So I'm recording this, it's right around Halloween time. And we are going to have a Halloween crawl or candy crawl at our office. And so I was at Walmart last night picking up a prescription and picking up bananas for the house and lunch meat and that kind of stuff. And I was there and I thought, hey, while I'm here, why don't I get a jump start, right? I'm a jump start being a week ahead. Hey, that's being a planner for me. So a week ahead of time, I am going and getting the candy for the candy crawl for next week. And when I'm ringing it up, I didn't even think to use my company credit card to be able to buy that candy. And it was legitimately, that's the candy. Okay, I ate a couple pieces on the way home. Don't tell the IRS that. But other than that, it's legitimately going to be used for the office. We're going to give that candy away. It was about $60 in candy. Those candies gotten expensive. It was like $20 a bag. So that $60 that I put on my personal credit card, I don't get to write that off. Now, it's not going to come through QuickBooks. Nobody's going to see it. It wasn't on my company credit card. How do I get reimbursed for that? That's what an accountable plan does. It allows you to write off those things that are maybe on your personal credit card that should have been business expenses. What about a meal? You go and you meet your friend for lunch and you think, hey, I've known Tony for years and years. We're going to talk personal stuff. And so you go and you buy lunch and you don't even think about it. You buy it on your personal credit card. For me personally, I have two credit cards. I have that I use on a regular basis, at least. One is my City Costco card that I use for all my personal stuff. And then I have my American Express card that I use for my business expenses. So I go to lunch with my friend Tony. I buy it on my personal card because it's a personal lunch. And then we go there and we sit down. We're at Chipotle, spent 20 something dollars on lunch because, I get like double chicken on my burrito bowl. And he starts asking me questions because he's thinking about starting a new business. So what did we end up doing for that hour? We talked business the entire time, but I bought it on my Citi Costco card. So how do I get reimbursed for that? That's what the accountable plan does, is it takes those personal expenses and moves it over to a business expense that you otherwise would not have been able to take advantage of. Another great opportunity that we have, another strategy that's available, and this is kind of a mix between, maybe this is a mid-level strategy, is the defined benefit plan or a solo 401k. And I say mid maybe because not everybody has the extra income available to be able to use this. Depends on if you have employees or if you don't, if you're ever going to. Solo 401ks, they supercharge your retirement savings with structures that allow $50,000, $100,000 in deductions. They're fantastic ways to be able to save money for retirement if that's something that you're looking for. Some people feel like, including one of my mentors, feels like he doesn't want to invest in the stock market. He invests back into his business. He feels like he's going to get a better return on his money by reinvesting it into his business, because when he turns around and sells his business, he's going to get a lot more for it than he ever would have in the stock market. So that's one idea that a lot of business owners have. Might be right, might not be right. You might want to diversify. That's not for me to decide. I'm not a licensed financial planner. You can talk to your financial planner about that. I'm simply bringing forward the tax strategy and the opportunity there. Another tax strategy is energy credits. Now, these are going to change a little bit depending on the year and what you're doing. With residential, they're expiring this year. The One Big Beautiful Bill kind of changed some of that, but it's still available. Commercial, a lot of it is available until the end of 2026. So take a look at what's available for you at your time that you're watching this or listening to this, but there are some opportunities there for you to be able to use it. So none of these strategies that we just talked about are shady. It's the difference between a W-2 employee at Starbucks. I was having this conversation with a financial planner at a Starbucks, and I was like, look, I'm able to write this coffee off. That person who just made the coffee can't, because they're a W-2 employee. Again, the government, they recognize those people that are really helping out the economy, growing the economy. The wealthy, they have teams helping them do it, to be proactive in it, not reactive, not waiting. So if you're missing things, let's be honest, most business owners are doing the work, but not reaping the rewards because they're missing the structure, right? If you're still using TurboTax on your own, if you're going to a CPA or tax pro at the last minute, you're surrendering. You're not being very savvy. If you're still a sole proprietor and you're making six figures and you're trying to figure out why you're paying $30,000 or more in taxes, I just had that conversation too. October 15th deadline. Somebody said to me, doesn't that feel like a lot in taxes? And I said, well, you just came to me a week ago. There's not a lot I can do about it now. If you're mixing your personal and business money, another huge no-no. Do not commingle your money. Have a separate bank account. Even if you are a sole proprietor, go get yourself a separate bank account. If you've got business expenses, make sure you're reimbursing yourself. Set up an accountable plan. Look those up. Get that structure put into place. If you're not forecasting your taxes until next tax season and you're relying on the little vouchers that come from your tax pro for your estimated taxes, you're not going to be very effective. Those aren't good tax strategies. If you're relying on your CPA to, quote unquote, just take care of it once a year, you're not being very savvy. It's not about working harder. It's about working smarter with your money, right? That sounds cliche, but that's honestly what it is. So here's the thing. IRS enforcement is ramping up. Now, granted, right now, some of them aren't working because of the government shutdown at the time of this recording, but that's not going to be forever, I don't think. I mean, let's be honest. It wouldn't be the worst thing in the world if it lasted forever, right? Just kidding. We need our government officials. Of course, the ones that we don't need are the ones that are still getting paid. But anyways, I digress. Don't get me on that tangent. The economy is changing, and tax laws are constantly changing. The one big beautiful bill put all of that in flux. We've got chaos right now. If you're not making intentional moves, you're gambling with your future. So the good news is you don't need to be rich to do any of this. You just need to be structured. You need to be proactive. You need to be strategic. You need someone who understands how to turn the tax code into a roadmap instead of a minefield. And guess what? I just happen to know somebody. That's right. We at Savvy Tax Strategies have a 360 tax plan, we call it, or a 360 tax assessment, we call it. And it helps you to understand what strategies you qualify for that make sense in your business. And so if that sounds like something that's interesting to you, we guarantee you, if you qualify, if you're somebody who we think would fit for this, we guarantee you that we're going to save you at least $10,000 in your taxes, or we will give you your money back. And quite honestly, I've never given money back because I only do these for clients that I know are going to be able to save at least $10,000 in taxes. I'm not going to take you on as a 360 tax assessment client if I can't do that. It doesn't make sense for me, so I'm not going to waste your time with a big sales pitch if it's not even something that's going to work for you. So if that sounds like something that would be of interest to you, go to meetwithsavvy.com, schedule a discovery call, talk to my client coordinator, and we'll get you on the books. We'll get a questionnaire filled out. We'll verify that it makes sense for you to move forward. We'll talk to you about it. We'll go through the whole process, what it includes, what it entails. We look at the last 2 years of your past tax returns. We'll audit those and make sure that they were done correctly. And then we'll look at your current profit and loss statement, whatever information you have to be able to look at strategies moving forward. The general guideline is that you need to be making at least $30,000 or paying $30,000 in taxes. So if you're paying $30,000 in taxes or more every year, go to the second page, top of second page of your 1040. If that says taxes paid more than $30,000, you probably qualify where we can help you out. And so with that, next episode, I'm really looking forward to being able to help you understand when you should be a DIYer still or when you should turn it over to a pro. And so with that, thanks for tuning in to Savvy or Surrender. If you found this valuable, please subscribe. I would greatly appreciate it. We're on YouTube there. Subscribe, become one of my, I think I'm up to 6 subscribers right now, so become my 7th. I would greatly appreciate it. And if you liked this episode, I would love a 5-star review as well. I don't think I have any reviews on the podcast yet. Here I am on episode number 9, and I don't have any reviews. Not even my mom. Come on, Mom. Seriously, Mom? Give me a review, please. All right, with that, I will see you next week. Until then, stay savvy.